Before we proceed to the more advanced material, I want to focus on the fundamentals of what banking actually is. Because you may ask, what is actually a bank? Do they lend money? Do they take deposits? Are they intermediaries? What about all the different types of banking? What about banking laws and risks and compliance? So we are going to focus on the essential terms and concepts of the banking practice. Let's cover some fundamentals of banking before we proceed with the course, because we want to know what we're talking about. So banks, by definition, are financial institutions that receive deposits and make loans with the same money, whether to individuals or to companies. This is traditional banking. It's all about taking deposits and lending. Now here's the key. Although they store capital, banks are by nature intermediaries in transactions, and in most cases, they lend the money of other investors through something called syndication, and not their own capital. So if they provide a 200 million loan, for example, they don't provide those 200 million. They go around shopping for investors who each take a piece, and together they provide the 200 million. As you're guessing, there are many different possible activities in banking, but these are usually split into two major groups. The first group is retail and commercial banking. It's traditional banking, what you think of when you think of a bank, and most of the profits come from the interest charged on loans minus the interest paid for deposits. Think of loans, credit cards, mortgages, and so on. Then we have investment banking and private banking, which is a completely different beast, and most of the profits actually derive from fees and commissions for mergers and acquisition advisory, broking, underwriting, or others. So these are the two major groups of banking activity. Interestingly enough, in many cases, depending on the regulation of the country and their market strategy, banks can actually include other types of non-bank financial institution as arms or divisions. For example, it's not uncommon for a major bank to operate, first, a hedge fund or a private equity fund or venture capital firm, or just a money management arm, or possibly a prime broker, that is, not an asset manager themselves, but the broker for other hedge funds, the bridge between the capital markets and the other funds, buying and selling securities in multiple markets, and possibly other services such as extending leverage or finding securities from another person to allow short selling, and more, or possibly having a treasury, custody, and trust services division for businesses who are clients, or even life insurance, or investment advisory, or wealth advisory, or succession planning for high net worth individuals. All of these can be divisions of bigger banks. It's interesting that, in terms of the lending market itself, so the major market of banks, banks are progressively losing market share to private lenders. And this is in large part due to their own fault. So banks are becoming more and more restricted in who they can lend to. They are allowed to take on progressively less and less risky loans historically. So other private lenders like mezzanine lenders, private credit funds, venture debt, distressed debt, and other variations of private lenders are increasing their market share in terms of lending every year that goes by. And here's the key. This is in no small part the bank's own fault. It's due to a large volume of low-quality loan and mortgage origination, the so-called no-doc loans, where they would provide loans or mortgages to people that absolutely could not repay them just to increase the banker's bonuses, and which was a very big factor in the 2008 subprime crisis. So regulators started going after the banks and restricting more and more the risky lending that they could perform. And this is what is decreasing their market share over time. Out of curiosity, there are other banking terms such as central banking, digital banking, that may not represent banks at all, but may be other institutions or may actually be components of actual banks. So first, we have central banks. And central banks are not actually banks per se, they're more regulators. So they don't lend to individuals or take deposits. They're a different type of entity. They're the central institution in a country that oversees banking, and they have goals such as what is called the US's dual mandate, promoting price stability and maximizing employment. So these two are the goals of the central bank of the United States, which is named the Federal Reserve. And other central banks have similar goals, and they oversee the banking activity in the whole country. Another term is fractional banking, and this is the name of a process or a principle. Specifically, it's the principle of holding in reserves only a portion of the deposits made, which corresponds to the expected loss on loans. Let me clarify. For example, the bank is currently lending 20 billion, but it estimates that there will only be 2 billion in losses, on average, due to their specific quantitative modeling. Then, they only need to hold those 2 billion in reserves. It's the bank's cushion in case things go wrong. As the name says, the bank only holds a fraction of the deposits, which corresponds to the losses that they expect to incur. Another term is challenger banks. And challenger banks are merely smaller banks that are competing with big ones. As the name says, they're challenging them. This is because barriers in banking are becoming lower and lower. One example are digital banks, which we'll cover literally in the next point. But because these are only digital and they don't need branches or human capital, they can compete with other banks much more easily. So they're challenging the incumbents. Then, digital banks themselves. So these are banks that, as the name says, are digital only. They have no branches, no big buildings with glass walls. In many cases, they only provide web or mobile interfaces, and in many cases, they even lack traditional bank services. In products, such as a checking account, they may just provide fixed-term deposits or fixed-term loans. Another interesting term is correspondent banking, and this is the name given to the process of a bank liaising with other banks, especially if one of the banks has a less reputation or comes from a different country. So for example, let's say that you're a bank in the US that receives a request for a loan from another bank, which may be a smaller agricultural bank in rural Spain, for example, and you have no idea whether it's creditworthy because you don't even know who that bank is. So a bigger, reputable bank, such as Santander, for example, can mediate the process. They do the diligence on that bank and they mediate the communication. As the name says, they act as a correspondent bank in the process. They kind of share their reputation with the smaller bank. And finally, it's also important to just be aware of the several bills and acts and reforms and directives that have been passed over time and that have imposed controls or directives on banking activity. First came the Glass-Steagall Act. This act forced the separation of retail or commercial banking and investment banking. And this was back in 1933. And it occurred because investment banking is more volatile. It deals with capital markets. So you could have a bank that's taking 200 million from small consumer deposits from farmers, bakers, and then almost gambling a portion of that money in underwriting risky securities for a big company transaction. And when that didn't work out, guess who lost the money? So this is the reason why, for example, a bank can have a smaller asset management fund that's controlled, but they can't be an asset management fund themselves. Traditional lending activity and capital market activity must be separated. Then we have the Sarbanes-Oxley Act. This was passed around 2002 after the Enron scandal. It's frequently mentioned regarding companies, but it also affects banks. So what it did is it increased penalties for illegal activities such as insider trading or securities fraud, as well as the increased reporting of companies and banks related to these operations. So when you see, for example, people getting sued for insider trading and going to jail nowadays, it's because of this act. The next one is the Dodd-Frank Act, and this one was passed around 2010 in response to the 2008 subprime crisis. It included several measures which were precisely to counter the causes of that crisis. For example, it included preventing banks from becoming too big to fail. What I mean is that if a bank owes 300 billion, there's no way to fix that problem without the government stepping in. So the only way is to prevent the bank from reaching that size by consistently breaking it down into smaller units. But it also included other measures, such as constant stress tests, so constantly simulating what happens if certain scenarios play out. Also, the monitoring of derivatives, especially if they have a lot of leverage included, as well as consumer protection. In short, banks can't sell dangerous and complex products to their clients and claim that they're safe. It also included, in specific, the Volcker rule, and this dictates that banks can't do speculative trading. So as we mentioned, they can have an asset management arm, but they can't do asset management themselves. At the time, they could, and this was one of the big reasons why they imploded. So in 2008, you would have these leveraged asset-backed structured products such as CDOs, or collateralized debt obligations. So what happened was that banks sold these products to their clients, but they also speculated in these themselves and held a large quantity of these. So what happened is that when the subprime market was wiped out, the clients of the banks were wiped out, but the banks themselves were wiped out as well. Suddenly, they would have 100, 200, 300 billion of debt because of this. And this is why nowadays they can't speculate. So they can't sell products to their clients, but they can't own them themselves. It's also important to mention the Basel III Accord. And this is a set of comprehensive risk management measures from 2010 as well. It's the third iteration of the Basel framework, which was created by a consortium of central banks of multiple countries. And it involves multiple risk management measures to keep banks in check. For example, minimum capital requirements by tier. So there's tier 1 capital and tier 2 capital. Tier 2 is dangerous. It's usually unsecured loans. If there's a default, it's worth nothing. So there's a ratio that must be enforced. For example, only 5% of the capital can be tier 2, period. So if the bank holds 100 billion, only 5 billion can be tier 2 capital or unsecured loans. And whenever one of the capital quantities change, measures must be taken for the ratio to be upheld. So if the capital of the bank in deposits goes from 100 billion to 90 billion, then those 5 billion have to decrease as well to keep the ratio. Or, for example, having dynamic reserves by cycle stage. What I mean is that if a bank has $20 billion in reserves for defaults, at the good point of an economic cycle, if there's a crisis, they must reevaluate the probabilities of default and increase the reserves accordingly. This is to prevent banks from filling up their portfolios of loans during the good part of a cycle and then the reserves not being enough when the bad part of the cycle comes. It also includes requirements for leverage and liquidity. Leverage meaning that the bank can't have over a certain percentage of borrowed capital, while liquidity means that a certain percentage of assets must be easily convertible to cash. For example, it's irrelevant if the bank has 100 billion in assets if they can't even sell 1 billion to meet an obligation when they need to. What are some examples? The first is the reason for the Glass-Steagall Act, not risking depositors. This is why it separated traditional lending and investment banking, so that the risk capital markets activity has to be funded with its own money. It's not going to be the small consumers with their deposits who are going to be funding the risky activities and who get wiped out if the bank gets them wrong. Then derivatives. Derivatives and options, out of curiosity, are some of the easiest securities to manipulate balance sheets. And this is because they're not on the balance sheet. What I mean by this is the following. They represent future gains or losses, not present gains or losses. And because of this, they don't appear on the balance sheet. For example, let's say that you have 50 million in oil, and you sell those 50 million in oil and buy 50 million of oil futures. Those 50 million have now disappeared from the balance sheet because the oil as a commodity was a present asset, but a derivative is a possibly future gain, not a present one. And out of curiosity, these can also be used for tax fraud, because by replacing real assets with derivatives, a banker can make it seem like they have less gains and pay less taxes. There are many shady maneuvers that can be used with derivatives, and usually the ALM or Asset Liability Management desk looks out for both what's on the balance sheet and what's off the balance sheet. But this is just to give you an idea of how this can be manipulated. What's on paper is not everything. And finally, a lot of the Dodd-Frank Act was reversed under Trump. Surprise, surprise. A lot of the protections that were forced by the Dodd-Frank Act, including forcing bank transparency about lending or investment products, or clarifying the dangers to their customers, was reverted by Trump's cabinet, making banks not required to be transparent about lending or investing again. What are our key takeaways here? The first is that banking is a simple business. They take deposits and they make loans. They are a middleman in financial transactions. This is traditional banking, using deposits to make loans and making a profit on the difference in interest rates. Then, depending on the regulation of the country, banks may include a myriad of other non-bank financial institutions, from proprietary trading desks to brokerage, wealth management, insurance, or others. Then, central banks. These should not be considered banks per se. They're more regulators than they are banks. They set monetary policy and they promote currency stability, as well as oversee banks in their country. And finally, there are 4 major reforms that you can be aware of. Glass-Steagall separated investment banking and retail banking to protect the retail consumers. Sarbanes-Oxley increased penalties for financial fraud and increased the reporting requirements involving securities. The Dodd-Frank Act imposed transparency on banks, especially in terms of the products that are sold to consumers. And Basel III imposed risk management directives related to capital, liquidity, and more. So as we see, banking is all about taking deposits and making loans, and being an intermediary between these two. There's usually 2 major dimensions: retail or commercial banking and investment banking, as well as a lot of regulation and compliance, in many cases, due to the bank's own fault.